everyone. I'm Jaime Agostino. Welcome to another episode of Financial Minds Meet the Experts. The Fed meets next week, so you guessed it. I'm joined today by Tim Sustak, SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizzo Financial. We are here today to discuss our thoughts on next week's meeting. So, Scott, let's start with you. How would you describe the current state of the economy and what's driving that view?
Yeah, I think I would. It's tough. The economy's been very interesting over the last few months. I would describe it today, and really, if you you looked at it for the last few years, as very resilient. But there's still a lot of uncertainty. So I would say resilient with lots of uncertainty ahead, or in front of us, or even part of us right now. Uh, we've heard a lot about the K-shaped economy and the issues with the wealthy spending and the those that make less money spending less money, and that certainly is the case. But both groups are still spending money. As
Mhm.
long as the stock market is strong, then the higher earners who are heavily invested or more heavily invested in the stock market should be continuing to spend, and they have been. We've had a nice recent rally in the stock market. After the Iran war started, things were kind of a little bit negative there, but they've since picked back up again. So things are looking pretty good with the high wealth consumers. So the concern has really been over the last few years has been these paycheck to paycheck folks that have been struggling,
Mhm.
lower income earners. But they have shown some resiliency. I would say a couple things there. When you look at the average pay raises over the last few years, they have early COVID, they did not keep pace with inflation, but then shortly thereafter, they started to keep pace and they were slightly above. So consumers, although it's still painful, obviously for all of us with higher prices, pay raises for most folks have remained above the level of inflation. So they're able to keep up, which is a positive thing. Um, and they've been able to continue to spend. We track credit card delinquencies and auto delinquencies internally because we invest in those sectors through asset-backed securities. We kind of saw those things bottom out middle of or early last year. They've since improved pretty well, so consumers are able to pay that. We've seen larger tax returns this year, not by the amount that we thought they might be. $1,000 is kind of the number we heard last year coming into this year, but the numbers are more in that 350, $300 to $350 is extra for the average tax return, which is still positive. On the negative side, obviously, is a lot of this has been eaten up by higher gasoline prices. So consumers are paying more for gas and diesel. If you have a diesel vehicle, you're probably not the happiest person right now because diesel prices have really gone higher, as there's been really more of a focus on regular gasoline. But prices are higher for all of us. We're paying more at the pump. And I'll point out that if you look at recessions since the 1970s, early 70s, other than COVID, they've all been preceded by an oil price shock, which is what we have had with this war in Iran. The hope is that this is short-lived, that these oil prices will, the conflict in Iran will end soon, and the oil prices will come back down. And we'll have to see the impact on the economy. If it's very short, the consumer may continue to be resilient and pull through this thing. But the concern is if it remains out there longer, if there's still issues in the Strait of Hormuz, then we're going to have issues with oil prices, and that's going to be a big thing for the consumer. It's a big hit. If it's temporary, not as big of an impact. And I'll just say too, I'll end with this on GDP. Third quarter GDP of last year was very strong, in that 4% range. We had the government shutdown, so the latest reading on the fourth quarter was a growth rate of 0.5%. So quite a big drop in the fourth quarter, but kind of driven by the government shutdown. We knew it was going to be lower. The projections for the first quarter, and this is by the Atlanta Fed, is about 1.5%, 1.7% for the first quarter based on data we're seeing now. So again, not super strong, but still positive. Consumers continue to spend. Go to restaurants. We've talked about this last year. You go to restaurants, they're still packed. You get on the flight, flights are still pretty well booked. And I will say, I've had to fly here some with work recently. Prices have gone up a decent amount on airline tickets, but consumers still find a way. So as long as the consumer remains resilient and the oil prices don't hit them, I think that we'll continue to plug along this year and we should be okay. But the big wild card is obviously oil prices.
Yeah, yeah. It kind of makes me chuckle. So you both know that, I have an 18-year-old daughter and she's a senior in high school and she said something to me the other day about gas prices. She's like, "Mom, it is so expensive to fill my gas tank." And it made me I just couldn't help but chuckle, it just, I mean, granted, she works at Chick-fil-A. She makes 12 something an hour, but she's like, that's really eating into my, how much I have, extra for things. And it was kind of interesting to hear it from that age bracket. But I think we probably said the same thing. It was 99 cents a gallon when I was her age, but I was only making $4 an hour.
Yeah, it certainly does impact, the things that she can buy and all of us, right? We're spending
Yeah.
more on gasoline, so there's less spent elsewhere. Because, we notice it. We go to the pump as your daughter has done, and you put the gas in, and it's an immediate impact. You see it immediately, and it comes out of your account immediately. So it's one of those things where we tend to downplay it a little bit, but it certainly impacts other things that we can do and spend.
Absolutely. Absolutely. So, Tim, let's talk about the job market. The job market has stayed surprisingly fairly strong. Are we starting to see any cracks, or is employment still holding up better than expected?
Yeah, I think overall, I mean, I would say no cracks. It's cooling. It's been gradually cooling over time, which, gradual cooling is fine. It's to your point, it's the cracks that we don't want to see. And I think you're right. I think we have not seen kind of the demise of the job market that some had predicted. For March payroll numbers, we saw 178,000 gain, mostly in healthcare, construction, and transportation. Up about 205 for the quarter, but still over the past year, all but net zero, right? So we're not really growing much. But the you know the thing is, there's a lot of swings, right? Month to month, you see payroll numbers that are up and down. We're gaining, we're dropping jobs, right? And overall, we see that kind of gradual downward trend. And unemployment's at 4.3% as of March, and that stayed fairly consistent over the year. And I think, that's the key to it. And if you listen to Chair Powell's press conferences, it's something he's talked about a lot. And that is, although we're certainly not creating the jobs we were a few years ago, we're seeing a gradual reduction in the workforce as well as a gradual reduction in job creation. So things are kind of balancing themselves out. I mean, largely along the lines of immigration policy and changes there. But AI is certainly also having an effect. I mean, if you're somebody looking for, college graduate looking for an entry level type job, you're certainly seeing the effects there. It's interesting, and you talk to people. Oh yeah, well, we're not going to hire any, junior developers or something like that inside of 5 years. Only people that have X amount of experience and more. And so, well, what are you going to know when those people age out? How are you going to get people into that next level, right? If you're not hiring anybody to start. So I don't know how that's going to ultimately shape out. I don't think anybody really does at this point, but it certainly is having an effect right now. And that's, part of that is working into what's helping to keep, I think, the job market fairly stable. So right now, I would say, you know, um, it's allowing the Fed to watch other things and not be so concerned about the job market. So we'll probably talk about those things a little later. But to your point, Jamie, so far so good. No real worries yet.
Okay. All right. So, Scott, let's look at inflation then. So, inflation has cooled, but it hasn't disappeared. Do you think it's sticky enough to, keep the Fed cautious?
Yeah, it has cooled somewhat, and the Fed will remain cautious about what related to it. And part of it's what we talked about. We have this temporary spike in oil prices that's really kind of spiked the inflation numbers and are expected to the other ones that come out. So, and we've seen a little bit of divergence between the two main readings that we look at from consumer price increases. CPI has been trending lower, and it's closer to the 2%, the Fed's 2% target. It had been closer to the Fed's 2% target, while the PCE deflator, which is kind of the Fed's preferred measure, which they look at the core reading there, that one has been very sticky. And it's been in that 3% or slightly over 3% range. It's kind of held steady there. We had a recent reading on the CPI that has incorporated some of the increases in oil and gasoline prices. So the latest reading on CPI over a monthly basis, the overall reading increased 0.9%. So while it had been below 3%, it is the overall reading for CPI is now above 3%. Because of that 0.9% increase. But on the core reading, the core only went up 0.1%. So the core reading, as a reminder, it excludes food and fuel prices. So if you take the gasoline out of it, then the inflation is still held relatively steady. So 3.3% overall was the reading, and then 2.6% was the core reading. Still a little bit of a concern there. The PCE deflator, we haven't had data yet that has incorporated the price changes with oil. But it's expected to do the same thing. It's expected to show an increase in the core of about 1% when the next reading comes out, which is a day after the Fed meets, is when that reading will come out. So we expect both of those, at least temporarily, to remain higher. The question is, even if they didn't, let's say if we took oil out of that, what would the Fed think? The Fed is still going to be cautious, even without the oil prices. Now they're using the word temporary with the oil prices, and that's the hope that it is a temporary increase, and it should feed through the economy. And then if things straighten out, it'll go back down very quickly. But again, we're still above the Fed's 2% target, so they are expressing caution. And I would say we talked about this on prior calls. It's a pretty even split at the Fed on those that are more concerned with inflation versus more concerned with jobs, as Tim talked about the job situation. It's a pretty even split, slightly skewed by 1 or 2 votes towards the more concerned about inflation, meaning we're okay staying on hold for a little bit longer to see how this plays out. So even taking out the oil shock, the Fed is kind of ready, are willing to let this kind of play out and see what it does, remain on hold for a little while, in their terms.
Yeah. Yeah. So then Tim, what's your read on the Fed right now? Are we looking at a higher for longer rate environment, or do you expect cuts anytime soon?
Big surprise. I'm in alignment with what Scott said. Because the reality is this: I don't see a cut anytime soon.
Yeah.
Given what we know now and bar any
Right.
major changes, right? And I say that for a few reasons. As we talked, like a labor picture certainly isn't booming, but it's stable enough that it allows the Fed some time to take a look at what's happening on the inflation side of the mandate and, choose their next move wisely. So I think at this point, and Scott, correct me if I'm wrong, the market's still showing no cut for the remainder of the year.
Yeah.
Yeah. Fed moved 75 basis points in the second half of last year, then kind of went on hold a little bit here. When you look at where they're at now, 3.5 to 375, you look at the minutes from the March meeting, I think generally the majority feels like they're in the range of somewhere around neutral, right? And nobody knows exactly where that is, something that either holds back or stimulates the economy as far as where the funds rate is. But I think the majority of them feel like they're somewhere around the range of neutral. And they're in a good position to sit and wait. And that's, I think what they're certainly going to do. The dots in March, to Scott's point, kind of showed that split. A little angled toward still a rate increase. But like I say, when you look at the minutes, it's pretty evident that they're on hold. There was even some talk in there about the possibility of the next move being an increase, just because they don't really know how the oil price shock is going to move through the inflation numbers. And we see that day to day, right? One day markets boom and everything's great. The next day it's, we seized a tanker and what's going to happen next. So we don't really know how long that oil price shock's going to remain. I mean, even if everything got worked out today, it's months before the strait gets worked out. And I think I heard, I think President Trump said it, hey, gas prices are likely to remain high through the end of the year based on what we know now. So, you know, difficult, but I think they're certainly on hold. I think something interesting is Fed Governor Waller, one who was really kind of tilted toward the side of being concerned about the job market, so much so that dissented a few meetings ago, and I forget which meeting exactly it was, but dissented in favor of a 25 basis point cut when they were on hold. Now kind of says, hey, you know what? Um, we're in a good place to sit and wait. He says that the Fed might have to stay on hold for a prolonged period until economic direction becomes clear, and that's from somebody who was kind of tilted the other way, just a few months ago. So certainly the Iran war has gotten everybody's attention as it rightly should. And, as Scott pointed out, just all of the uncertainty around it, makes it a prime time for the Fed to sit and wait and see what happens. And they feel like they're in a good spot where they're at with the Fed funds rate to be able to do just that. So
Okay.
that's what I'm thinking.
All right. All right. Thank you. So, Scott, if the economy weakens later this year, what's the biggest risk for credit unions and what should they be doing today to prepare?
Yeah, so I mean, I think if things start to weaken, we're going to see a few things happen. One is we'll see consumers cut back.
Okay.
Um, they tend to do that. They tend to save more money when we start to get to recessionary times, or if we're in a recession. So if that starts to happen, if we start to see layoffs, then certainly we'll start to see consumer cut back. So lending at credit unions is going to slow. Already coming into this year, the projections were for lower, really for a drop in the number of autos that consumers purchase. So there was already this expectation that we're going to be like 1 million units under where we were last year for autos. So consumers were kind of already expected to buy less cars anyway. But certainly, if we get to recessionary times, then it may cut that even more. So, if a credit union had projections this year of having a decent auto lending season, it may be a challenge to get there. We'll see how that plays out. But a big concern obviously is going to be defaults and delinquencies, whether it's with autos or credit cards, and those are things that bear keeping an eye on. Your CECL model should be tracking that and preparing you for that for those potential write downs or charge offs that you might have. But that's a big concern, is going to be how the consumer holds up. As I started this off with, we talked about the resiliency, and it's been really surprising to me how well the consumer has held in there. Um, because the level of debt in this country is very high. If you look at the numbers, the New York Fed publishes these numbers on a quarterly basis. If you look at the debt, it just continues this upward trajectory as it has over time. And most of that is tied to homes. It's mostly mortgages that we take out. That's the biggest part of consumer debt in this country. But there's a lot of debt out there. But on the flip side, if you look at like credit card usage versus credit card lines or availability,
Mhm.
and when you look at home equity line of credits, home equity availability versus what's being used, there's still a lot of unused debt out there that people have access to through credit cards or home equity lines. So those are areas too that you maybe want to keep an eye on and see, do some of your better credits, do you start to see these things start to go higher? And if so, if they're starting to tap into their lines more, then it may mean that they might have to, or maybe it's beneficial for them to start making some changes to the amount of line that's available, maybe cutting lines a little bit or things like that to get a little bit ahead of the curve. But certainly, I would anticipate some issues if we hit the recession with consumers being able to pay their bills. They've held up well, but at some point, at some point, you feel like it's going to break. And again, the markets 3 years ago thought we were going to have a recession that year. Never happened. The consumer has been very resilient. It's been I don't want to say it's a record, but we haven't had a recession in quite a while, right? Since COVID. And when you look at COVID, it was really a manufactured recession. It wasn't caused by issues in the economy, other than the economy's basically being shut down because of, to try to prevent the spread of COVID and save lives. So um, I call it kind of a manufactured recession, right? I'm not saying it wasn't necessary, but it was manufactured. It wasn't one that happened naturally. So, anyways, bear keeping an eye on the consumers and how they does that resiliency hold up or not.
All right. Well, based on what you just said, normally I wouldn't do a plug for a service here, but I feel like I need to just make our audience aware that, if default is a concern of yours, Vizzo Financial does have a new solution available, Default Sleuth. It'll actually take your data, look at your data, and be predictive to see which of your members might be on the verge of a default. So you can kind of look at it before it happens. So if that's something you're interested in, contact your corporate account manager. Obviously, they'll help you see a demo and get started. So before we close, thank you for joining me. But any final thoughts for our listeners today?
I guess I would just say, kind of follow what the Fed says. When you look at the minutes, one thing they pointed out was the necessity that they remain nimble as far as monetary policy. Because obviously, to state the obvious, right, in an environment like this, things can change quite rapidly, and we don't know which way they're going to go. So if you can remain, and it's easier said than done, right? Because there's a lot of things that are out of our control. But if you can remain as nimble as you can, as far as how you manage your balance sheet, don't get married to one outlook as far as where rates are going to go. Kind of, keep some powder dry, stay neutral if you can. It's probably a good time to do that.
All right. So, Tim, I'm going to ask you, is your word still uncertainty?
Yeah, I mean, holy heck, I think that word has gotten bigger, right?
All right. What about you, Scott? Any final thoughts?
This is just an interesting to me, maybe only thought, but we Fed Chair Powell, his term expires as the Fed chair, not as a member of the Fed, but as a Fed chair expires the middle of May. So we have a new nominee that the president has put forward, but there's some controversy. It's not necessarily about the nominee, but it's related to Chairman Powell and the renovations that have been going on at the Fed and the costs. President Trump wasn't happy about that. So they've done, the Department of Justice is doing an investigation. Long story short, we have a senator that's on the finance committee from North Carolina here, Tom Tillis, and he said he's not going to vote for this new Fed chair nominee to go forward, Kevin Warsh, that he's going to withhold his vote or vote no. So we'll have to see how that plays out because they're going to start to have these hearings and we're going to see what happens there. So it could be very interesting. And there's some debate on does let's say that the new person is not confirmed by the end of Chairman Powell's term. Can Chairman Powell stay in that position, or does President Trump, can he appoint somebody different who is already serving as a Fed member? There's some uncertainty. There's not really rules written around that as related to the Fed chair. So I just think it's going to be one of those things based on what we've seen already between Trump and Powell and the Fed there, that it may get pretty interesting here in May if Warsh is not confirmed by then. So just keep your eye on that. It just could be maybe interesting only to me, but I find it fascinating that we're, less than 2 months or we're less than a month away, right?
Yeah.
We're in mid-April already. So we're less than a month away from his term ending, and a new person still not confirmed or to be on there. So it's very interesting to me how it's going to play out. So I find that, if nothing else, interesting. But I do mimic what Tim said, is continue to listen to the Fed. We just may not know who the leader is in the middle of May. There's some uncertainty there. So
Yeah.
It's very interesting to me too, Scott. And correct me if I'm wrong. My understanding is that and this could make it extra interesting, is that although typically the chairman of the board is also the FOMC chair, that doesn't have to be the case. Technically, the FOMC named its own chair. So to your point, if Powell's still there, maybe President Trump names a new Fed chair, the FOMC could still vote to keep Powell as the FOMC chair, which kind of throws a bigger monkey wrench into it for the administration, right? I don't think that's ever happened, but it could, I think. So I don't know. What do you think, Deb?
Yeah, it is very interesting. That never has happened. And we look at the Fed, we always hear about how the Fed is apolitical. They're not political. They're not tied in it. But I would argue that they are political, in different senses. But I think that right now it's become very political. And Powell at his last press conference kind of welcomed the political side of things and brought the politics into it. So I don't know that we have what we would. I don't think we ever had an independent Fed, right? I think they're always beholden somewhat to who appointed them or whatever else. But it certainly could get pretty ugly here uh, in a month, especially like you said, if we had a separate Fed president, our chairman, and a different chairman of the FOMC. Could be very interesting. We've never had that before. New territory. And I'm with you. It very well could happen. It's not one of those things where you would assign really low probability. It certainly could happen. So stay tuned.
All
The
right.
fireworks.
Yeah, so we have uncertainty. We have I'm going to go with the word exciting to kind of watch what happens there with the chairman.
Yeah.
So those are our words for today. So thank you both so much for joining me as always. To our audience, don't forget to subscribe, share your thoughts. Stay tuned for Vizzo Financial's post-Fed meeting analysis with Tim with his FOMC update next week. Also, special thanks to Vizzo Financial's blog for sponsoring today's episode. Vizzo Financial's blog is a fun and easy way to find new information and insights, discover credit union knowledge and news curated just for you, the credit union industry. In the month of April, the following articles were posted: for employee experience, a pay it forward strategy, financial literacy that retains talent; from innovation and technology, stablecoin, fast, secure, flexible, and stable; risk management, AI in business resilience, a lesson in risk versus reward. See more of these articles by visiting Vizzo Financial's website at www.vfccu.org. Next week, we will return to our series on meeting the various teams at Vizzo Financial that are accelerating credit union success. As always, thanks for listening and make it a great day.